When it comes to the housing economy, let me know if this resonates with you. Would you agree that as, at least in Minnesota, as the housing economy started going up in 2012 and massive appreciation, it was pretty tough to really make too much of a mistake when everything was going up at such a high price. In 2022, if you adjust for inflation and started to see the market flatten, going into about 3 years now. I know certain neighborhoods have seen a little bit of appreciation still, but as you start to compare it to increasing insurance and property taxes and labor maintenance and all that, we're starting to see it flatten out more in real terms. The thing is a new realtor article, and the realtor articles are very optimistic. I guess a new article came out, and they are saying it could. I think they're talking about underwater people on underwater mortgages, but I haven't gone through the whole article other than just the headlines and some of the subcontext. But I think it's saying that it could be up to 10 years before people break even now on that. So you take the 10 years plus the 3 years, and who knows what inflation's going to be. That's 13 years right there. That's a pretty long time. So that's something to keep in mind. So the action in time that people put in to build everything up worked in the past. Would you be open to the fact that it might take a different approach this time into the future, such as maybe a little bit more meditation into clarity, alignment, and kind of receiving insights so that you can kind of flow with more of a flow state and a creativity it takes a different level beyond thinking, analyzing, to have creativity on how to solve the current problems in the economy right now, right? The part from a polarity standpoint that looks like a big unwind that I think people really need to think about is we're talking about a 30 to 40 year span of where Japan was very much had 0% or low rates for a very long time, which in a way subsidized the lifestyle in America. And we are now seeing that the rates are rising quite a bit. There's this big, people were leveraging off of that. So like what I'm saying is, if people say, well, I didn't take too much leverage buying some of the single family homes here in some nice cities in Minnesota. It's like, well, yeah, but you're within a system of a bigger system. And there were a massive amount of people, trillions and trillions of dollars, that were leveraging all this really low money. And that's what happened in crypto. People doing 50 and 100 times leverage, and it was all starting to unwind. And it didn't take much, 1 or 2% difference, and it liquidated people. So liquidation is a challenge. Deleveraging of people that are over leveraging is a challenge as well. The number one creditor was Japan at the $3 trillion of U.S. treasuries, and affects the bond market and all that stuff. There's a big unwind. So as that all unwinds over in their economy, that hits the whole global system. And I want to lead you into a video that explains this a lot more, so that you can see how the liquidity is coming out of the market. And as liquidity maybe crystallizes back into frozenness, you're going to see the markets maybe freeze up more, and you're going to see houses sit on the market longer and stuff like that. So just something to be aware of. I think it makes sense if you look at it. It's just time to pause a little bit more and be creative. So clearly you can tell after watching the video that there's going to be a lot of motivated sellers out there. Minnesota inventory is going to go up, and it's going to be increased competition, and then from there prices come down. That's just how the supply and demand works. I want people to be prepared for it. I want to look for the motivated sellers and be prepared with the hard money or cash, or how to negotiate for seller financing terms. A good place you can learn that is a two-sided marketplace of the polarity and kind of the inverse of the seller buyer, which is at the first Tuesday night, MNREIA, during the haves and wants section at 7 p.m. Just grab a mic, get on there, say what you have, say what you're looking to buy, and write down some phone numbers. There's a yellow sheet in the back where you can also write it down, and it'll show up in the newsletter as well for the members. So keep that in mind, and let's get you into the video.
Japan is closing in on the government debt endgame. Has the fiat collapse chosen its first big target? Last week, Japanese bond yields soared to 40-year highs as fears grow that Japan's out-of-control debt will lead to out-of-control inflation. The trigger was yet another $135 billion stimulus package, that's almost $1 trillion in U.S. terms, printing government debt hand over fist to buy a couple more months for Japan's debt-swamped zombie economy. The package sent bond yields soaring as markets bet Japan's inflation will keep rising, while raising fears whether Japan can handle its colossal government debt that's equivalent to $70 trillion in U.S. terms. This puts Japan in a no-win situation. If it keeps rates low, the zombie economy keeps going, inflation keeps rising, the yen crashes, import prices soar, and Mrs. Watanabe, who votes, cannot afford rice. But if they hike rates, interest payments on government debt spirals out of control, while Japanese businesses are starved of capital, so tax revenue collapses. Miraculously, Japan managed to step on both landmines at once with a massive stimulus package that both hikes inflation and raises interest costs. The background here is Japan's central bank manipulated cheap interest rates in the 1980s to drive an epic economic bubble. At one point, the land in Tokyo was worth more than all the land in the United States. The land under the Imperial Palace was worth more than the state of California. Japanese companies were buying everything in sight from the Hollywood studios to the Rockefeller Center. As always, the central bank boom was a tissue fire. It burned bright and it burned short. When it burned out, Japan embarked on 35 years of stimulus with near-zero interest rates and an endless series of stimulus packages, summing to over half of GDP, so that's about $15 trillion in stimulus in U.S. terms. Essentially, it was the 2008 Wall Street bailout, but for the entire Japanese economy. The money did not buy back the boom. What it did buy was keeping Japan's zombie companies on life support, hogging up workers and capital so new startups could not enter. So today, 1 in 5 listed Japanese companies are zombies, meaning they can't pay interest on their debt out of operating profit. They suck up over 30% of all bank lending and hog up almost 10 million workers, essentially paid to lose money. As a result, while American productivity grew by half since 1990, Japan is actually a quarter less productive than 35 years ago. Real wages are literally lower than 1990. Japan went backwards just like Argentina. Meanwhile, all that stimulus drove Japan's public debt to 250% of GDP, over twice the U.S. number. Interest payments alone now eat up over a third of Japanese tax revenue, and if rates rise another couple points, it'll be 2/3 in interest alone. So what's next? Brought to you by I Trust Capital. Japan spent 30 years refusing to let weak companies die. Now the entire economy is dying. And when the music stops, the shock waves will hit America. Japan is the biggest holder of U.S. federal debt, and toss in Japanese pensions and banks, and they hold over $3 trillion in American assets. So if Japan hits the fan, these will be liquidated, tanking American stocks and bonds, while crushing the so-called yen carry trade that's driven the global everything bubble since COVID. The only solution is for Japan to massively cut government spending, which will not happen since it would set off the worst recession since World War II. So Japan is stuck, sleepwalking, buying time with stimulus, and praying that markets don't wake up. Okay, we'll be watching. See you next time.